this section, we'll explore how organizations promote ethical behavior through internal audits, whistleblowing systems, and codes of conduct that keep accountants accountable and the profession
The
credible.
rise of artificial intelligence has introduced new complexities to an already established accounting ethical code. The challenge itself is not whether AI can be governed ethically, but whether accountants can use AI to govern and uphold the 5 fundamental principles.
Then we move on to ethics in accounting. Ethics in accounting refers to the moral principles and professional standards that guide accountants in ensuring trust, transparency, and fairness in the financial reporting and decision making. Then we have the 5 fundamental ethical principles, which are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Integrity. This is the cornerstone of trust. It is defined as to be straightforward and honest in all professional and business relationships. Then we have objectivity. This is not to compromise professional or business judgment because of bias, conflict of interest, or undue influence of others. Then we also have professional competence and due care, an ongoing commitment to your level of professional knowledge and skill. Confidentiality. You should not disclose professional information unless you have specific permission or a legal or professional duty to do so. And lastly, we have professional behavior. This is to comply with relevant laws and regulations and avoid any conduct that the professional accountant knows or should know might discredit their profession.
The Enron scandal is a key example of the consequences of companies failing to adhere to ethical accounting practices. Enron's management deliberately used complex financial structures to hide their debt and their financial instability, eventually leading to its bankruptcy and the dissolution of the biggest audit firm at the time, Arthur Andersen. Enron was in breach of multiple accounting principles, the first one being honesty and integrity. As mentioned before, Enron used complex financial structures to hide their debt and to deceive investors and creditors into thinking the company was financially healthier than it was, showing low debts and higher profits than the company was actually incurring. Moving on, the company was also in breach of objectivity. The audit firm, Arthur Andersen, was both the external auditor and the consultant, which led to a conflict of interest between the two roles. Arthur Andersen was both the external auditor and the consultant for Enron, leading to a conflict of interest between the firm's two roles. This eventually led to Arthur Andersen approving multi-risk and questionable accounting practices in return for high profits and huge contracts. To add on, the CFO, Andrew Foster, was put in charge of the special purpose entities in which he had a personal financial stake that was influencing his decisions. Moving on, the company was in breach of the accounting principle, professional competence, and due care. Enron's management pressured their lawyers, Vincent and Elkins, into approving investor and employers fraud. They also pressured their lawyers into writing letters condoning the use of the special purpose entities, which were merely just being used to manipulate the financial statements of the company. Now, how did monitoring systems fail to detect these accounting practices? Well, first off, the auditor Arthur Andersen was more focused on retaining profits from their consulting role instead of actually auditing the company. The SEC also had underfunding and lacked technical expertise to understand the complex new age financial instruments Enron was using. Moreover, stock analysts were too reliant on the Enron's financial statements as it was a huge corporation in the USA. Now, what were the lessons learned from this scandal? Well, first off, there was the development of the Sarbanes-Oxley Act, which requires CEOs and CFOs to personally certify the accuracy of financial statements to make them legally accountable for those documents. Second off, there was the development of the Public Accounting Oversight Board, which independently investigates public accounting firms. Financial standards also required financial reporting to not only report the legal form, but also the economic reality. Third off, companies learned to have strict codes of conduct and that important figures are not exempt from rules.
So we'll be looking at the 5 different ways that ethical conduct is monitored. So first off, we have internal controls and audits. So this is where we have authorization processes and strict internal functions to ensure that employees are adhering to ethical conduct within the workplace. The next one which we have is whistleblowing systems. The introduction of whistleblowing systems allows employees to report unethical conduct anonymously, which allows open channels of communication between employees and authorities. Up next, we also have code of conduct enforcement. So this is basically the rules which professionals must adhere to, which encourage and foster ethical conduct within the workplace. And then up next, we have ethics committees and training. So with the ACCA professional program, before you become a member, you're expected to complete the ethics and professional skills module. So this is where we have our training aspect in ethics, and then with ethics committees, it basically are just organizations that encourage and continue to spread awareness about ethical conduct within the workplace. So in addition to internal controls, we also have external firms which are overviewing organizations, and they do this by continually monitoring and enforcing penalties when ethics have been breached. Ethical success means creating a workplace where integrity, transparency, and accountability are built into daily operations. It's not about just avoiding wrongdoing, it's about doing what's right even when no one is watching. Importance of ethical success. It builds trust and reputation with customers and investors. It also ensures compliance with laws and standards. This means that following ethical guidelines helps the company adhere to legal and industry requirements, reducing the risk of penalties. It also protects the company from fraud and corruption. Lastly, it improves employee morale and long-term sustainability. Moving on to achieving ethical success. How do companies achieve ethical success? They use ethical monitoring and controls through internal controls, audits, and technology to detect and prevent unethical behavior early. There's also internal audits and reviews and whistleblower systems, and also ethical training and awareness. This means that ongoing ethical training and awareness programs educate employees on how companies value ethical decision-making and acceptable workplace conduct. There's also use of technology and AI monitoring. But as technology, especially AI, becomes more common, there's an important question. Without ethics, accounting collapses, but will AI strengthen or weaken ethics? The answer is, it can do both. AI can strengthen ethics by catching fraud and bias faster than humans. But if used carelessly, it can also create new risks like unfair decision-making and data misuse. So, ethical monitoring must evolve with technology, guided by transparency, fairness, and accountability. In short, ethical success protects reputation, it prevents fraud, and it builds trust.
Artificial intelligence is transforming the accounting world, but this raises an important question. Will AI replace accountants or reshape their roles? In this section, we'll look at how AI impacts accounting, how ethics remain vital in guiding its use.
I'll be leading you on to AI in accounting. AI in accounting consists of many applications and technologies that fundamentally alter how financial information is analyzed and processed, or just how financial information is managed and utilized. This involves the application of machine learning, whereby algorithms are taught how to detect suspicious and legitimate transactions. We also have natural language processing, whereby computers are enabled how to interpret, understand, and generate human language. Lastly, robotic process automation, which automates repetitive and routine tasks. The implementation of machine learning algorithms to mitigate fraudulent activities through tasks like risk assessment, financial forecasting, and fraud detection. Generative AI tools like the natural language processing, which makes time-consuming aspects of tax compliance processes easier as it analyzes unstructured financial data such as reports and documents, facilitating more efficient data processing and compliance monitoring. The benefits of AI in accounting, we know that it improves reliability, helps in fraud detection, and also reduces error rate.
Now, the question is, which tasks are going to be automated and emerge due to AI? We understand that tasks have been changed due to AI, and our normal natural role have been changed. For example, repeated and routine tasks like customer support, data entry and processing, and reconciliation are going to be the first to be automated and will definitely reduce in size and even disappear due to AI. But with that being said, it doesn't really replace our roles, but actually change how things work in the workplace. For example, roles like AI ethics and oversight officers, AI auditors, and AI literacy trainees are going to emerge to help with ensuring that the use of AI in workplaces is going to be full of transparency, fairness, and to ensure that information is good and accurate. For example, in EY, they've developed a new AI tool called EYQ to help with internal auditing. It doesn't really do everything, but because it's not really that accurate, but they ensure that the work is done, but it in fact reduces the workload. Now we move on to AI over-reliance, which is a huge risk in audit firms, as for example in Deloitte Australia, where they depended on AI to develop the reports which made them owe the government $440,000 US. So instead of fighting against AI, we should work together to know how we can work together, because success depends on people that work towards using AI than against it.
Now we'll be taking a look at ethical considerations of AI and the risks that come with using AI. We're going to look at three main risks, the first one being data privacy. So, data privacy, you see that AI is used to process vast amounts of accounting information that ranges from bank details to tax records and other financial transactions. The issue with this is that sensitive information is prone to data breaches. This is because, let's say for example, when accountants use AI tools that were developed by third parties, they may have limited control over how the systems then process their financial information. This then affects ethical principles that were developed by the Ethical Principles Board. And you see that data breaches and cyber attacks affect the integrity of the financial service provider and furthermore affect the confidentiality agreement between the client themselves and the service provider. Now we'll be looking at the last ethical risk, being accounting gap. Let's say, for example, an AI system makes a flawed audit assessment or makes a misleading financial report. Who is then responsible for it? Is it the developer of the AI system or the accountant that used it? This then creates a sense of ambiguity and a lack of direct accountability in such situations, which then challenges the ethical principle of professional responsibility. With that said, accountants need to make sure that they act with due care and validate the AI systems that they use so that they may prevent discrepancies that may occur in the future. Then the second risk that we'll be looking at is algorithm bias. Algorithmic bias occurs when systematic errors in machine learning algorithms produce unfair or discriminatory outcomes. This occurs because mainly AI systems or algorithms learn from historical data. The risk that comes with this is that the AI systems may unintentionally replicate and amplify errors that may have occurred in the previous accounting periods or previous historical data. This affects the accounting ethical principles of objectivity and fairness, and this means that accountants need to regularly review the systems that they use and make sure that they are transparent. Now looking at the conclusion, you see that ethics and AI must work hand in hand. While AI offers innovation, efficiency, and accuracy, it is notable that accountants must carefully integrate the use of AI systems into their work, such that the accounting ethical principles, being objectivity, integrity, professional competence and due care, professional behavior, as well as confidentiality, are then upheld to the highest degree. Ethical decision-making will always require human input, so AI should work hand in hand, such that it supports the human judgment but does not entirely replace it. Thank you.